Imagine you retire with $1 million and you walk straight into the worst market timing in modern history. That is the retiree we are going to follow today. Someone who clocked out on December 31st, 1999 and retired in January 2000, straight into a lost decade with 2 brutal crashes, a market that goes nowhere for years, and the grind that drags on for 2 decades. They did not do anything wrong. They just got unlucky. You do not get to choose which set of market conditions you retire into when you walk off the job. It is plain luck, and the market does not care how carefully you planned. So the question is not how to predict the bad years or dodge them, because nobody can. The question is whether there's a set of rules that can carry you through the worst of them, protect your paycheck when the market falls apart, and still leave you better off than the textbook. That is exactly what I'm going to show you. I'm going to run this unlucky retiree through 3 different strategies, year by year, dollar by dollar, against the most famous retirement rule that everyone has heard of. And by the end, you will see how the guardrails protect you on the way down in one of the worst retirement sequences we have on record, and whether they hold up against the single biggest fear every retiree has, running out of money. So here's the setup. Both retirees start with the same starting portfolio balances, and we are going to run each of them through the 3 different ways to handle retirement and watch what happens to the same person under each one. The first strategy is the one almost everyone has heard of, the 4% rule. You hold a plain 60-40 portfolio, 60% in an S&P 500 fund and 40% in a total bond fund like AGG or BND, and you never change that mix. You take 4% of your starting capital in year 1, that is $40,000 on $1 million, and every year after that you give yourself a raise for inflation. It does not look at the market. It does not care if your portfolio just got cut in half or just doubled. The check goes up with inflation, and that is it. This is the textbook. Bengen's research in 1994, the Trinity study in 1998. Every retirement plan on the internet runs some version of it or compares itself to it. It is the one everybody studies for a reason, and I am going to give it a fair shake today because it does some things genuinely well. The other 2 strategies are mine. They both run the same withdrawal system that I call the hybrid 6% rule, and they both run the same bond rule underneath. My quarterly Treasury rotation that shifts between short and medium-term Treasuries on signal. The first version is plain stocks and bonds, no options. Anyone can run it in any account. The stocks are any S&P 500 ETF, and the bonds are that Treasury rotation. The second version is the barbell, which uses a small sleeve of long-dated options on the S&P 500 for growth and a big sleeve of those same Treasuries for safety. Both run the exact same rules, just on a different portfolio underneath. So whether you trade options or you never want to touch them, there is a version of this for you. Quick recap on the rules themselves because I am not going to reteach them today. The hybrid 6% rule is a set of guardrails. You take 6% of the highest value your portfolio has ever hit, and it steps you down to 5 and then 4% when the market drops. Then back up when it recovers. Underneath that is a floor that protects your income against inflation. There is a kicker that buys the market when it is deeply down. And there is a 9% ceiling, so you never strip mine a beaten down account. 4 rules. If you want the complete build on any of this, the portfolios, the kicker, the barbell, the rules in full detail, it is all laid out in 2 playlists on my channel. The Foundational Flight Plan and the Glide Path to Retirement, both linked in the description. This video stands on its own, but if a question pops up while you're watching, odds are I have already answered in depth in one of those. Now back to our unlucky retiree, the retiree who clocked out on December 31st, 1999 and walked into the new millennium with $1 million and then caught just about every punch the market had to throw. The dot-com bust in the first 3 years, then the great financial crisis in 2008. There was a lost decade where the market basically went nowhere for 10 years. And then 2022 when stocks and bonds fell at the same time. 4 major events in 25 years, back to back to back to back. If you ever wanted to design the worst possible time to retire in modern history, this is as close as it gets. Now a heads up before we get into it. This part is data heavy. I am going to hit the highlights and tell you the story, the years that actually mattered, but every single year is on the screen as we go. So if you want to walk it dollar by dollar, pause the video on the tables and take your time. 2 quick notes on how to read them. The dollar figures you see each year are the account values at the yearly rebalance and 1 snapshot per year. And then when I talk about max drawdown in each crash, that is measured peak to trough, the deepest point the account actually hit along the way. So pause it wherever you want a closer look. Otherwise, stick with me and I will call out the years that matter. Before the first crash even hits, the three strategies have already split. The 4% rule retiree takes $40,000. Both of my hybrid 6% rule retirees take $60,000. So with the same starting dollar amount, the hybrid 6% rule retirees are already living 50% better before anything has ever happened. Then the dot-com crash hits all three. 3 straight down years, and by the end of 2002, everybody is hurting. The 4% rule retirees portfolio is down to about $769,000, off more than 23% from where they started. The no options hybrid 6% rule retiree is sitting at about $725,000. The barbell is at about $764,000. 3 years into retirement, all three have lost roughly a quarter of their money, and they have been pulling an income out of it the whole time. That is the exact nightmare every retiree is afraid of, watching a quarter of your nest egg vanish right out of the gate. Now, watch what the hybrid 6% rule does on its way down, because this is where it protects you. As the portfolio falls, the guardrail throttles the paycheck down. 6% steps to 5% in 2002, so both hybrid 6% rule retirees pull about $50,000 that year instead of their old $60,000. Then the market keeps falling, and by 2003, the guardrail has stepped them all the way down to the 4% COLA floor, about $42,500. And look at what that floor is doing. That $42,500 is essentially the same check the plain 4% rule retiree is taking. Just like I mentioned in the setup, the hybrid 6% rule retiree is matched right up against the 4% rule retiree dollar for dollar and protected from going any lower. That sounds like a punishment taking a smaller check. It is actually the rule protecting the portfolio, pulling less out of the account exactly when it can least afford to give it. This early stretch, the crash landing right at the start of retirement, is what is called sequence of returns risk and is the single most dangerous thing that can happen to a retiree. Bad years early while you are drawing income do far more damage than the same bad years later. It is the exact thing that breaks retirements, and it is the exact thing these guardrails are built to survive. And one important thing about that paycheck, because it changes how the pay cut feels. Think of your portfolio as your new employer and that withdrawal as your salary. It is not every last dollar you have to your name. You still keep an emergency fund, you still budget the same as you did when you had a job. So when the market throttles your salary from 6% down to 5 or 4%, that pay cut does not land on your life. It lands on your buffer first. You feel it slowly as a signal to tighten up a little, take one less trip, not as a cliff you fall off of. This is what makes the guardrail something you can actually live with. I have got a whole video coming on exactly how to structure that paycheck, but for today, just know the pay cut hits the buffer, not you. And that 4% COLA floor, which is holding you at the same paycheck as the 4% rule retiree, is only half of it. Because while the 4% rule just sits there and takes the same check, the hybrid 6% rule is about to do something the 4% rule can never do. And that something is the move that changes the entire retirement. By the end of 2002, the market itself, the S&P 500, is down about 40% from its peak. And a 40% drop in the market is the exact trigger for the kicker. Here is what the kicker does in plain English. Both hybrid 6% rule retirees take their entire safe sleeve, the Treasuries, and they pour all of it into the S&P 500. They are buying the market while it is on the floor at the exact moment everybody else is too scared to touch it. The 4% rule retiree does nothing here. It just holds on and hopes the market comes back. Watch what that one move buys. The kicker fires in 2003 for both hybrid 6% rule retirees, and it stays in through 2005, riding the recovery off the bottom before it unwinds once the market has climbed back. But here is where the two of them separate from each other, and it comes down to the paycheck. By the end of 2005, the barbell retiree has already earned its full 6% paycheck back and is sitting at about $1,022,000, above where they started. The no options retiree is climbing right alongside it up to $917,000, already well ahead of the 4% rule retiree, but his paycheck is still throttled to a 4% COLA floor. He is in the same kicker, buying the same bottom, but his portfolio has not yet climbed back to its old high, so his raise has not kicked in yet. The barbell got his paycheck back first because that big option sleeve grows the portfolio faster, which lifts it back sooner to the high water mark. And the 4% rule retiree that same year is stuck down around $869,000 with no kicker, no recovery move, nothing to do but wait. And before we leave the dot-com crash, look at what it actually did to each portfolio at the worst point, because that is the number that matters most to a retiree. From peak to trough, the S&P 500 lost about 49%. Nearly half the market gone. Now look at our three retirees. The 4% retiree's deepest drawdown was about 27%. The no options hybrid 6% rule retiree about 30%. The barbell about 27%. The market fell about half, and every one of these structures cut the market's worst pain while pulling income out the entire time. Then 2008 hits, the deepest crash of the entire retirement. The 4% rule retiree drops to about $714,000, the lowest point they ever see. But look at where the two hybrid 6% rule retirees are standing when it lands. The no options retiree, even still throttled on the floor, only falls to about $781,000, already sitting ahead of the 4% rule retiree. And the barbell, which had recovered back to the full 6% paycheck by 2007, rides 2008 down from a much higher base and lands at about $923,000, even after the worst crash year. Then the kicker fires again in 2009 and 2010, buying the financial crisis bottom exactly the way it bought it in the dot-com. And this is where the two hybrid 6% rule retirees pull away for good. By 2010, the no options retiree is back up over $1 million, and the barbell is up to about $1.3 million, while the 4% rule retiree is still grinding down around $782,000. In 2011, the no options retiree finally breaks out of the 4% COLA floor and back to the full 6% paycheck. The barbell broke out years earlier. From here on, both hybrid 6% rule retirees spend almost the entire rest of the retirement taking the full 6% paycheck, while the 4% rule retiree just plods along with its small inflation-adjusted paycheck. And the financial crisis is where you see the worst drawdown of the whole retirement. From peak to trough, the S&P 500 lost about 57%, the deepest decline since the Great Depression. The 4% rule retiree's deepest drawdown was about 35%. The no options hybrid 6% rule retiree about 39%, while the barbell was about 42%. So again, the market lost more than half, and all three structures held the damage while paying a paycheck the whole way. I want to point out something important about these drawdown numbers because it looks backwards at first. The plain 4% rule retiree actually had the shallowest drawdown of the three at the very bottom, about 35%, while the two hybrid 6% rule retirees dipped a touch deeper, around 39 and 42%. And here's why. The 4% rule held its bond cushion the entire way down. It never sold its protection, so at the very bottom, it was still carrying its safety. The hybrid 6% rule retirees did the opposite. Their kicker fired when the market was about 42% off its peak, and at that moment, they sold their entire safe sleeve and went fully into the S&P 500 with no bonds left. But the market did not bottom at 42%. It kept falling down to about 57%. So that last leg, roughly another 15% of decline, hit them with no bond cushion at all because they had deliberately traded it away to buy the recovery. That is where the extra few points come from. The 4% rule retiree rolled that final leg with bonds still softening the blow. The hybrid 6% rule retirees took the slightly deeper dip because they were buying the bottom. And that purchase is exactly what powered that faster, richer recovery you just watched. A couple extra points of drawdown in exchange for 2 decades of a bigger paycheck and a far bigger portfolio. That is the kicker. It may cost you a little at the bottom because no one can truly time a market bottom. But when it recovers, it pays you back on the way up. And this is exactly why I call the kicker the optional rule in my system. It is by far the hardest thing to actually pull the trigger on. Everything in your body is going to scream at you to hold on to your bonds and wait it out. And the kicker asks you to do the opposite, to sell your safety and buy stocks while the market is still falling and the headlines are at their worst. Most people cannot stomach that, and that is okay. The guardrails, the 4% COLA floor, and the 9% ceiling do the heavy lifting, whether you ever fire the kicker or not. The kicker is the extra credit for the investor who can keep the nerve when it counts. So what rescued the 4% rule retiree shrinking account? One thing, the 2010s. The S&P 500 ran one of the strongest 12-year stretches in American history, compounding around 16% a year. And that historic bull market is the only thing that dragged this portfolio back over $1 million by 2021. One more sideways decade in there, and this story ends differently. And then 2022 arrived, the fourth crisis, the last event in the string of crashes I promised you at the start. This one was different from anything else in the retirement, and it is the one everyone still asks about to this day, because 2022, that was the year that stocks and bonds fell at the same time. The thing that is not supposed to happen. Normally, when stocks drop, your bonds hold the line and cushion the fall. In 2022, they both went down together, so there was nowhere to hide. From peak to trough, the market fell about 25%, milder than the first two crashes, but with no safe harbor in bonds, it landed differently on each of these three retirees. The plain 4% rule retiree on standard total market bonds had a drawdown of about 25%. The no options hybrid 6% rule retiree had a drawdown of about 24%. A slightly smoother ride even than the single worst year for bonds. And the barbell had the deepest at about 30%. That spread is the whole story of 2022. Both hybrid 6% rule retirees run the same bond rule, the quarterly Treasury rotation, and it did its job for both of them, moving to short-term Treasuries and dodging most of the bond crash. This is why the no options retiree rode smoother than the plain 4% rule retiree, whose standard bonds fell hard. The barbell ran the same bond rule, so its bonds were fine too. It just drew down the deepest simply because when the market sells off, the option sleeve takes the hit. That is just how options behave in a downturn, and it is the one environment where the barbell rides the roughest. But even in its worst drawdown of the retirement, look at where the barbell sat. Still more than twice what the 4% rule retiree had left. And the guardrails did exactly what they are built to do. The no options hybrid 6% rule retiree throttled its paycheck to 5% in 2023, and the barbell, it actually throttled all the way to 4% lock in 2023 and 2024, both protecting the account through the rough patch. The fourth crisis handled the same way the system handled the first three, throttle to protect and then hold. So the 4% rule retiree clawed back to about $984,000 by the end of 2024. On paper, they made it. They never ran out. By the strict letter of the 4% rule, this retiree won. But I want you to look at what surviving actually cost them. They started in 2000 with $1 million, and they ended 2024 with a portfolio of $984,000. The number on the statement barely moved, so it looks like they came out even, but inflation did not pause. Over those 25 years, it ran about 78% total. To hold the same buying power that original million had walking in the door, the account would need to be worth about $1.78 million at the end. At $984,000, the portfolio ended almost $800,000 short of that mark. Their paycheck went up with inflation the whole way. They were never short on income. It is the nest egg itself that fell behind, ending at barely half the real value of the million they started with. Let's be honest here, because the sequence was so brutal, it did not spare everybody. Hold all three portfolios up against that same $1.78 million bar, the 4% rule retiree at about $984,000 ended furthest behind, the account holding roughly 45% less real value than the original million. The no options hybrid 6% rule retiree ended at about $1.43 million. So even after keeping his paycheck ahead of inflation the entire way and finishing far ahead of the 4% rule, the portfolio still landed below that $1.78 million line, about 20% short of preserving the original million's real value. That is how vicious this particular sequence was. The income held up for both. It is the nest egg that the market could not fully protect for two of the three. Only the barbell beats it on both counts. It ended at $2.27 million, which is not just ahead on paper. It is about 28% above the inflation bar in real terms. The barbell was the one strategy whose growth engine carried the portfolio itself past a 25-year inflation grind and in the worst retirement sequence we have on record. Before I show you where they all landed, I want to walk you through one of the numbers that matters most to retiree. The actual paycheck year by year, because the ending balance is nice, but you do not spend an ending balance. You spend the check that hits your account every year. So let me show you what each of these three retirees actually got paid all the way through. It starts the way you already know. Day 1, 2000, the 4% rule retiree takes $40,000. Both hybrid 6% rule retirees take $60,000. Then watch what the crash does. By 2002, the guardrails have stepped down both hybrid 6% rule retirees down to 5% rate, about $50,000. Then in 2003 at the bottom, they step all the way down to the floor of $42,500. And that floor is exactly the 4% rule retirees check. For those years at the bottom, everybody is taking essentially the same paycheck. But look at what happens coming out of it. By 2005, the barbell has broken back to its full 6% and jumps to about $63,000 a year, while the 4% rule retiree is still creeping along at $45,000, and the no options retiree still throttled at the floor near $46,000. The recovery is where the paychecks start to separate. Then the financial crisis hits and the checks converge one more time. In 2009, near the bottom, all three are back down together around $50,000, everyone protected. And then the same thing happens again, except bigger. The barbell comes off the floor first, jumping to about $72,000 in 2010, while the other two are still near $50,000. By 2011, the no options retiree finally breaks out too, climbing into the 60,000s. And from there, the gap just widens every year. By 2015, the barbell is paying about $104,000 a year, the no options about $73,000, and the 4% rule retiree is still grinding along in the $50,000. And here is the home stretch. You can see the 2022 throttle land in 2023 and 2024, where the checks step back down as the guardrails protect the account. At our 2024 finish line, the barbell retiree is taking about $90,000 throttled down to protect itself, the no options retiree about $86,000, and the 4% rule retiree about $71,000. Even in that protective crouch, both hybrid 6% rule retirees are still out earning the textbook. And every single time the market crashed, those checks came down and met at the floor. So the hybrid retirees were never once taking less than the 4% rule retiree in a bad year. So 25 years later, after every crash, here is where the same unlucky retiree ends up under each of these three strategies. The 4% rule retiree pulled about $1.34 million in income across the whole retirement and ended with about $984,000 in the account. The no options hybrid 6% rule retiree, the plain stocks and treasuries version, pulled about $1.56 million in income and ended with about $1.43 million. And the barbell, the conservative 80-20, pulled about $2.03 million in income and ended with about $2.27 million in the account. One quick note here before we move on. I stopped every number at this episode at the end of 2024, so they line up exactly with my original 4% rules episode at the same finish line. If you run it one more year into 2025, nothing about the story really changes. It just keeps going. The 4% rule ticks up to a little over $1 million. The no options hybrid keeps climbing, and the barbell, which was throttled down protecting itself after 2022, it jumps right back to the full 6% paycheck. I just wanted these numbers to match dollar for dollar where we left this retiree the first time. So step back and look at what just happened, because this is the whole point of part one. The retiree caught every punch the market has thrown in the last 25 years. The dot-com crash, the financial crisis, an entire lost decade, and the dual crash of 2022. One of the single worst sequences we have on record. And the 4% rule got them through it. But there is a second way the 4% rule fails, and it is the exact opposite problem. What happens if you retire lucky into a great market and the rule handcuffs you into a frozen paycheck while millions pile up that you are never allowed to spend? That is the retiree we follow in part two, and it is just as broken in the other direction. I will see you there. So drop a comment and tell me, knowing what you just watched the unlucky retiree go through, would you still run the plain 4% rule, or would you rather have the guardrails and the floor working for you when the market falls apart? If this made the downside protection finally click the way the floors hold the paycheck and the kicker buys the bottom, hit the like button. And if you want rules-based retirement investing without the hype, the kind where I show you the mechanics and then prove them with decades of real data, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.